Hey everyone, we're going to be doing a video with Moritz coming up just after this, but I wanted to kind of take this time to go through a couple things. Um, I put in some charts and some things that will make you kind of think about trend following a little bit differently. I think I talk about trend following so much, or how to trade using a trend system, and I don't think it makes a lot of sense to most people because the questions are good. I think people think it's something about buying highs or parabolic breaks or something, and that's not exactly the case at all. There's many different ways of doing it, and most of the time when I'm talking about using a back tested system, something that you can back test, see over and over again that this works, and then push it forward into your trading. And that also doesn't mean you just use, one system and this works on, you just use it on a couple things and that's the end of it. There's also many other aspects of it. The mental aspect of trading, though, is kind of similar across the board, and I wrote some notes to kind of go through it. Um, don't let your emotions jump up and down and fluctuate with your capital. This is something that's really important that I think a lot of people overlook. Like, you really have to be even. I always kind of explain it as like a good football player, a good basketball player. Kevin Durant's kind of an easy way to pick that up. Anybody who watches basketball, you watch the guy hit a game winner and he's kind of just walking off the court like, that's what he does. And that's the truth. You don't want to miss that and then be upset all night and distraught and hate yourself over it. And then when you make a good trade, you don't want to think you know, basically cured cancer or something. You didn't do either one of those. You're following your plan, you're following your system, you're doing exactly what you're supposed to do. You have to be consistent and even tempered. And this is very important, and it's on that same subject where it's not every trade's going to be a winner. That doesn't mean it's a bad trade. So Larry Height said it best, which is there are good bets and bad bets, and then good bets where you make money and good bets where you lose money, bad bets where you make money and bad bets when you lose money. And what that means is if you're not following a system or a plan, and something I learned very early in trading, many years ago, when I told somebody, it was one of my mentors, it was first learning, and I said, "Hey, I just did this trade, I made some money, it's cool." He said, "Okay, so how did you do it?" And I didn't really have a good explanation, and he said, "Well, it doesn't mean anything." He said, "If you can't do it again and again, what does it matter? You made some money. I mean, if you look at the market, it jumps up and down all the time. Anybody can make money, but how do you do it again and again and consistently?" And that's the importance of following a plan and following a system and being even as you're doing this. Now, judge yourself by the outcome, or judge yourself not by your outcome, but by your process. All right, do you have a consistent process? Do you know exactly why you put on a trade and exactly why you take off a trade? Does that happen before you put on the trade? I think the one most important thing that I see with people who are trading poorly is that I will watch them be in a position and something will come up that will change their mind on that position completely. Um, some news item will come out, something will just happen. They'll be looking at their profits and they'll say, "Wow, that's a lot of profits. I think I got to get out of this trade." And this happens consistently with traders over and over again. And even I see that even on a professional level, because that's the thing. It's something you can always do better. That's something you will always be working on. How exactly do you do this better? And it's the same thing that everybody says: let your profits run, cut your losses early. And this is really important. And I think so many people don't understand that aspect of trend trading in general, or just trading. Really, like you have to have a trend to trade right. You can't trade well without a trend. It's not going to make money if it's stuck in a range. So you got to be. Everybody has to be a trend follower in some sense, no matter what time frame, what style trading you're in. Um, know what you're going to do when the market does what it is going to do. And this is another important thing, and I picked this one up from one of the old Turtle Trader books, and that's the importance of having your trading plan. You have to have a trading plan in place so you know exactly what you're going to do. You also want to mentally rehearse it. What if everything comes against you and kicks you in the head one morning and you wake up to a very tough trade? So you put on a trade It went completely against you. Maybe your whole portfolio is going against you. How are you going to handle that? Are you going to panic, sell all positions? What's your risk management in there, and so on? And so that's a couple of things that's important on the mental side of trading. Now, what we're doing as trend followers is we're trying to make profits in up or down markets. So that means that we can make money in trends on the long side. We can make money in trends on the short side. We do not care. We do not have a bias. I'm not sitting here going, coffee has to go up forever because I love coffee. I don't think it doesn't matter that Apple's a great company or I use their phone. To me, it's either an uptrend or a downtrend, and I will happily short it just as well as I will go long it. Buying and holding, and reading something to kind of confirm your confirmation bias over and over again is not what we do either. If we're sitting there and kind of going, oh yeah, look at this on the news and all these things, and most of the time when you're in a position, any news that's positive on this, of course, you're going to think it's great. News sounds awesome that when you're in a stock and it's going up and the news is great, you're going to think that's all amazing. And anything price wise or anything is always going to be amazing. This is why you want to have your idea beforehand. So, we're not just buying and holding these for the long term and just hoping and praying that something happens. We have no problem getting out of a position when it turns against us and getting into a position that's turning for us. And so, and we know the big money is really in letting your profits run. And so when you have these, there's a difference between buy and hold. For example, if you're in something like Bitcoin 2017, you make a lot of money. It goes all the way up to, basically, I think it's $2017 $1,000 to 20,000, and then when it turns down against you, where do you get out? That for us is important. And getting out is also a thing where you can get right back in. If the trend changes to long again, we can get right back in the trade. We have no problem doing that any trade we're in, whatever product we are in as well. Risk management is always top priority for us as trend traders. So because we're trying to we understand that there's always a risk in markets. There is no such thing as I know this for a fact. There's lots of people who thought they did that in trading many times, and it's always turned out very badly. So we always know there's a risk in trading. So with that risk, we know that we want to put on stop losses. There's many ways of doing stop losses. There's a systematic way. You can do ATR stops, using 5 ATRs to 10 ATRs, whatever you need to do on a daily time frame to put a trailing stop in. We usually use trailing stops, meaning if and these change based on the product. So if we're doing something like Bitcoin, we might have a trailing stop all the way to 30%. It's a very volatile thing. A daily move in Bitcoin could be easily 10% in a day, sometimes even more. But if you have something like a bond, that'll have a tighter stop, maybe somewhere around 10%, 12%, meaning because a bond moving 1% a day is kind of it happens, but it's not really something that happens all the time. So we have to understand that this is something. There's a big difference in these markets. So I'm going to have a wider stop on one, a closer stop on the other, but overall always a stop loss, because there's always the unknown, and there's always the ability for a position to go against you. Very hard. Taking advantage of mass psychology is another piece of what we do. So basically, when there's euphoria and everybody's going a direction and nobody can explain why, you're looking at P ratios on a stock, you're looking at the Fed tightening, let's say all these things are happening, but the stock continues to go higher and higher and higher. Nobody has any real idea why. Trend followers are very good at that. We're the type to be in those positions, and just understanding that most things go up a lot further than anybody can dream of. Most things go down a lot further than anybody can dream of. That's just the markets. That's what they do. So understanding behavior psychology and behavior finance will kind of help you to put that into motion for yourself, so you can really hold on to these type of trades, because at a certain point it gets pretty it's hard for a lot of people to hold on and handle those profits, not want to just jump out and do something different, because you've made all those profits. Why wouldn't you want to just run? But we know that, a 100% move can turn into a 150% move, a 300% move, a 400%. You never know where things are going to stop. So our goal is to try to be in those. And also the point of that is when you have, if you have like a bunch of trades that aren't, because that's the other point of trading is you don't know, there's no trader in the world who's right every single time. There's none. You might find some people who like to pretend they are, and you might people might think that someone like me, I sit in a room, I come up with an idea, and I take all of the money for my clients and I put it into blank, and this then makes me, money in their account. That's not how that works either. So there's always a possibility of it being a loser. So we want to lose very small, 1% of the portfolio, 2% of the portfolio at absolute the most. But trading, losing small and then winning big, and these big winners can pay for all of your losses. So if you have, let's say you actually have a bad trading stint, you're wrong 10 times in a row, and this is all 1% losses in your portfolio, so it's a total of 10% of your total portfolio, and then you make one trade, and then that's 10% added to your entire portfolio, and you basically have made up all those losses in just one trade. So we also know that making these big outsized winners, because that's what we're really looking for as trend followers. We're looking for those outliers, those big trades that aren't always coming up every single day, and making ourselves in position to get into those trades easier and easier over time. And so this is also kind of it's a more scientific approach to trading, where you're basically I'm not just speculating. We're not just thinking about what trading should be. We're kind of jumping in and going, okay, we've back tested this. We know this works generally. That doesn't mean that the future is going to work exactly the same, but that does mean that I do have an outline of what can possibly happen. And so because of this, I know that trends usually change in this style or this fashion, and I should get into this trade like this. So Moritz was very generous with his time. I've always been a big fan of the guy. He's really a thinker when it comes to quantitative trading. And I think we lack a lot of that in the trend following space, because I think so many people want to just go, well, this is the perfect style of trading, and if you don't do this, you're stupid. And I think most people in trading are kind of that style. And I'm certainly more of a hybrid. I'm not just a blanket statement trend follower. I don't just use only trend models. I have a couple other models that I use, but I'm quantitative pretty much across the board. So, we all have different styles, but I think Moritz kind of jumped into a couple interesting things that were different than most people would say, and things that I haven't heard him talk about before on any of the other channels, which are kind of how he diversifies his trend following. Because for me, I use different time frames, different styles of trading. I even have mean reversion systems. I have all types of trading systems that I do that kind of across the board. This also kind of smooths portfolio volatility. And he also uses other things to do that. I'll let him explain that too. But I think this is a really good thing. I've kind of put some charts in there just to kind of give you guys something to check out, kind of pay attention to, and it might make some more sense about what trend following is by the end of this. So hope everybody had a good day, and let's jump into it. The journey when you just got started, you're looking around at all these different things, and you've talked about it before. You kind of went through a fundamental phase, and not even a fundamental phase, just a normal stock trader's phase, and then you kind of get into this trend following. Where did you figure out that this was kind of an idea that you were interested in looking into deeper?
Well, that is many, many years ago. I mean, I tried out many things, but trend following is kind of like always there. When you read books, you read about the big traders, the turtles, etc. Then, you get in touch with trend following, and it's relatively easy to understand, like as a concept. I mean, you can think of something as simple as a moving average, 200-day moving average, and you can use that to build a trend following system. It may not be the best trend following system that you can come up with, but it is a start, and it's actually quite good. So testing these things has been relatively easy and straightforward. And I did a lot of research, a lot of testing. I think I tested literally everything under the moon. And I also researched other things next to trend following, mean reversion, long short type of trading, things that can be systematized. But over the years, and it took me a while. I mean, I don't want to sound like, I looked at trend following and the coin immediately dropped and that was it. It took many years to really, embrace it, be able to live with it, with all the ups and downs, with the volatility, with profit givebacks and these type of things. But I've come to realize it's the perfect trading strategy for me. I think it's, the most protective trading strategy that I can think of. It protects my downside. I can trade a diverse portfolio of markets using the same techniques on every market. It's very robust. And I can sleep pretty well at night because I kind of feel that I'm not going to blow up. There isn't going to be, well, it's a very, very unlikely event for something to happen to really blow up my trend following portfolio. So it's super protective, and at the same time, it's generating great returns. That's why I love it.
And I think you brought up a great point there, which it works for me, and that's what I feel like, something I say so much to people that I think they just overlook, because my personality type is I don't want to be sitting here. If I look at 5-minute bars, I'll probably end up beating my head against the wall in an hour. 5-minute bars would drive me crazy. Looking at things on an hourly chart would drive me crazy. And not to mention, I haven't really found an edge in any of it, and so because I don't have an edge in it, it doesn't fit my personality type, I couldn't do it, and not to mention the amount of money I would probably lose, because every time I've ever looked at one of those systems on a very short-term time frame, slippage, commissions, whatever, it just, at some point you're just losing money. And with trend following, it's like you're really looking for these major moves. You get this chance to kind of, hey, I'm going to put this on and I'm going to leave, I'm not looking at, there's nothing on any of these screens that has, I don't have a ton of screens, but on any screen that has anything up of my accounts or anything, I don't want to see what my profits are every day. I don't want to go through that emotional roller coaster of, yeah, I'm doing great, and oh no, I'm losing money. And, my mental being so connected to me trading well or trading badly. And so, that kind of works so well for me as well. So I just wanted to go, that's a great point. And so basically kind of getting into that, what did you first start? Like, what was your first system? You're a systematic quant. So your first system that you started to use, that you were like, what, this is something that works for me. Was it something moving average based? Was it a breakout system?
Yeah, it was an exponentially weighted moving average. So not a simple moving average. And this is years ago, and I didn't have, a large portfolio in terms of AUM. So I couldn't trade a lot of markets, and I couldn't combine a lot of systems. But I had to start somewhere. So you start with a moving average type of strategy, and you can design that in such way that, if the spot or if the market is greater than the moving average, say as of the open or as of the close or as of the futures contract settlement, then you'd have a long position. And if the reverse is true, then you'd have a short position. This is how I started. Now, there's a couple of things here with that type of setup that I do not like, and therefore I'm no longer trading that. First of all, I think breakouts are a nicer and cleaner way for me to trade. Over the very long run, whether you're trading moving averages or breakouts, at the end of the day, you're catching a trend. Your entry is going to be slightly different, may actually be identical, but over time it's going to be slightly different. Your exits are going to be slightly different, but you're getting kind of like the bulk of the trend with both systems. So both are trend following systems, but I definitely wanted to have something that has a neutral zone. So you can do that also with moving average type of systems, so that you're not forced to be either long or short all the time. You can configure systems with moving averages that would have a neutral positioning. But I did that with breakouts, and I do have that naturally built in. So I don't necessarily have a position in every market that I trade. And I found that very important, because I don't want to be exposed to markets that are choppy, sideways, range bound, these type of things, not with a trend following system. So that's how I got started. And then I think I fine-tuned this over the years, testing different things, different time frames, speeds, entry and exit methodologies, adding more markets to it, making sure that I can trade as many independent and unrelated markets as I possibly can. Starting to trade smaller with the number of markets increasing. So you have a little bit of risk in every single trade. It's kind of like you have this betting mentality. You go to a blackjack table every time you bet on a market, same type of bet size, do it over and over again. This is how this, developed. And I still look at the system and research it, and I think a lot about it. Not necessarily here when I sit on my desk. I'm not looking at the screen thinking about how can I change my trend following trading system today. This is more something like, when I go for a run or I'm on a bike or have a longer car drive, then I think about stuff and maybe something comes to mind and that intrigues me and that stimulates some research, and I do possibly then change things, but it happens very rarely these days. I think I have a very vanilla, very clean trend following configuration for my system. I'm very happy with it. I trade relatively high vol. It's choppy at times. There are drawdowns, there are profit givebacks. It's sometimes not as easy to look at the thing, even though last year and this year as well has been absolutely a great start to the year, by the way. So that's a lot of fun, but I'm willing to trade in that way because I trade to make money. I'm not trading to have a feel-good type of feedback from my system that's kind of like smooth and making 50 basis points every month and that type of stuff in a vol-controlled environment, because that really doesn't move the needle for me. I really want the thing to make money, and that means I need to trade at higher volatility. And I had to kind of like wire my head over the years to accept that kind of like feedback from my system that it is choppy at times and there can be large losses on, well, I shouldn't say that. There's always a small loss, but there could be like a large give back of profit. And you might initially say that's bad. I'm giving back a lot of open trade equity, a lot of open profits. And your head kind of like says you don't want that. That's emotionally difficult. Over the years, I came to love those losses. I love the winners. I love the losses as well, because that just means that I'm following my system. I just, let those profits come back. It goes into the exit of the position. I'm out of the trade. I may have now made less money than, yesterday or the day before when the market was still higher and had higher profits. But hell, that's the game. It could also have gone further up, right? And increase my profits. And I'm really looking to chase these massive outlier trades and sometimes even optionalize them, where it's like, I'm doing equity replacement trades or things like that to increase the convexity of my portfolio even more.
Awesome. And yeah, that's something that I think, a couple things you mentioned, which was going into a trade and understanding the difference between a moving average system and a breakout system, and being stuck in a range and not. Stuck in a range in trading is probably the most annoying thing you can do as a trader, because it's just, you're sitting there, you're watching everything jump up and down every single day. There's nothing to do. And so why would you want to be in the market like that? And a moving average system, whether it's a crossover system, buying it over a moving average, you're kind of always in a trade, long or short sometimes, especially a crossover system. You're going to be long or short whenever, and kind of just being out of that market. And not to mention your other point, which is when you're doing this, you're not just looking at, hey, I'm going to trade the E-minis and that's it. You're looking at hundreds of different markets, taking signals in these markets as they come. And so putting that all together, it's kind of a really great system, and it's a really great style of trading. And I think a lot of people miss that point, which you just talked about, which is those outlier events. You're looking for those major moves. And it's like, 2020 was a very great market for trend followers like us. 2021, 2022. Now that this month of this year, it's kind of funny to think that everybody who I've talked to has had a miserable time, because most of the managers, they're trading, not the managers that are in futures, but most of the managers that are just equity managers, they're in the tech market. And so they're having a miserable time right now, like that, you know, and there's all the, to us, there's like, it's like, why would you trade that right now? You know, I have nothing to buy the NASDAQ right now. I wouldn't touch anything inside of it at the moment. But so many people are kind of stuck in that mindset of tech went up for 10 years, you know, it's going to go up for another 20 and 30 and it'll happen forever. And they're kind of stuck in that. So as we're looking at this kind of, these situations for these outliers, we're also looking across all these different markets. And so I think
Yeah.
that's a really great way to say that. And so, you know, looking for these things and these systems, how important is back testing? Because this is something I
Like,
kind of have a lot of conversations about
yeah.
with people, and nobody seems to want to back test, but I think it's the most important thing. And I'd love to get your feedback on that.
Yeah, no, it is very important. I'll get to that in a second. I'm just looking at my portfolio here because you've mentioned NASDAQ and you know, the start of the year. I don't have a NASDAQ position. I don't have any mini position in the S&P 500 right now. In fact, I'm actually very light on equity exposure in my system right now.
Yeah.
That certainly was different a month or two ago. I'm short most of the bonds. And the short-term interest rates, I mean, those have been a primary driver of the good performance this year in January and in February now. The grains are still moving nicely, energy to the top side. So I'm, you know, long crude and essentially the petroleum complex all around. So that's all good. Emissions, fantastic, still long, you know, gas, super volatile. It's just a great trading environment. And by the way, I trade spreads as well. We can speak about that in a second. But yeah, backtesting is super important because um, it gives me a sample size and it gives me a basis to work off of. You know, and I want that sample size to be as large as possible because the larger it is, the more reliable it is, right? If you have a system that doesn't have a lot of parameters, but it has done, say, 2,000 or 3,000 trades, well, then all of a sudden you're looking at a body of evidence that you can kind of like, you know, draw conclusions from.
Mhm.
If you want to trade tech stocks in the NASDAQ, and you do this on a fundamental basis, I'm sure there's people that do that really well. And they do fundamental research and they find these gems and there are long stocks that go up and they don't touch the ones that go down. But that's just not me. I mean, that's one of the things, right? Everybody has to do what everybody gets out of the markets. What, you know, this is the Etsy Coda quote, what they want. You have to find the thing that works for you. And you read that in the Market Wizards book over and over. And I'm a quant slash systematic trader. So I want the systems to do the job. And I need to be the operator that is in a position to follow the systems and not override them, not over-optimize them, not overrule them, kind of stick to the rules, just follow through. This is the difficult part, but the backtest is super important. I mean, just test these things, test your ideas, see what works, make sure that you're not overfitting the thing. But what could there be better than this? Because if nothing that a fundamental trader cannot backtest anything, nothing. So it's just, that's not for me. I want to see what it would have done in the past.
Yeah, and I think that the thing is that a lot of people don't understand is that, let's say you decide that you're like, you know what, at the end of this, I'm going to share every single system that I have ever created and everybody can use them. Nobody's going to continue to use them, because if you don't have the back test and you don't understand that this system has this type of drawdown, this system can do this, you need to be diversified, you need to do all these things. If you don't understand all of those things, the second the system starts giving money back, you're not going to use it anymore. And that next trade could be the trade that you catch that outlier that we're looking for. And so I think so many people, they really pass on the back testing because that's the hard part for most people. For me, I enjoy it, but I know a lot of people are like, you know, that's a lot of work, whether they're doing it. And nowadays it's like, you know, you just pump a couple things into a computer and you can really, I mean, there's so many sites now that back testing has become extremely easy. And when I started, I was on an Excel sheet and then coding, and that, you know, and then you continue to move forward. And now you've got TradeStation, you've got TrendSpider, you've got all of these things that you can kind of use backtest very easily. And so many people kind of still pass on it. And you really have to understand that This system has this type of a drawdown. This system, I could be looking for this type of profit, this sort of possibility, and this is my time frame. All these things are kind of important, you know, and general time frame. It's not a I know exactly. You're never going to know exactly, but things generally. I'm a long-term trader. I trade off of this type of price action system, this type of model. So that makes a lot of sense, and I think, like you said, it's so important, and it's something that so many
Yeah.
people don't do.
I think it's also important to not get carried away by a backtest, which is very easy to to get done if you're looking at the equity curve and you're changing a parameter and you see how the equity curve, the historical equity curve changes, and that's a trap, I think, because it kind of like it gets into your head and you see this equity curve, and that then becomes your expectation of the system going forward. You have a certain path that has been realized in the past. Now, it's very unlikely / impossible for the same path. The same path isn't going to be in the future, right? Maybe a similar path, a similar kind of like sequence of events, but never the same thing. So when you look at the curve, really, I think you have to step back and say, probably the future is going to be worse than what I've seen. I mean, at least this is it could be the same, right? But put your mind into, hey, that has worked really nicely in the past. Maybe discount that a little, don't rely on the same curve coming up in kind of like the same way with the same type of characteristics. And you can do that by focusing more on the trade statistics, especially if you have a large sample size. Look at the, your win-loss ratio, trade length, number of trades, average win, average loss, and don't translate that into a growth curve. But just look at these statistics. These statistics are now just numbers. They're not moving from the bottom left to the top right. And that is the betting mentality. Then again, you then say, okay, I'm going to play another 2,000 hands of that game, which has the edge as shown in the trade stats. And the outcome, therefore, should be positive. But I don't know how I go from here to here. It might be choppy. It might be any type of path, right? It's not going to be the same that we had in the history. It's going to be any new type of path, but the edge should eventually play out. That is how I do that today. I didn't do that in the beginning, but I really do that way today.
I think everybody, including myself, we like to start out optimistic, and then over time, as a trader, you realize that like that's almost hurting you, to start out and have this idea that you're just going to go straight up, and this is the past works exactly like the future. And yeah, like you have to have some form of conviction in your system. But I think, like you said, it's also important to understand that the system could not work. It could not work in the future. And I think that's also a good characteristic of most good trend following traders in the first place, is that they look at it that way. They don't have crazy optimistic projections, and the past would tell you that there has been crazy optimistic trading in the trend following space. So it's very important to have that, just to kind of keep yourself at ease, your mind at ease. You're not getting too overboard and thinking that, hey, I figured it out. This is it. Like there is no, this is it in trading. That there's so many things that just work once and then kind of fizzle out, and that can happen to any system.
Look, I think, I just wanted to figure out what works for me. And at the very start, I mean, you read books, you read research, you see strategies, and you become aware of strategies, and other hedge funds say, right? And they say, I have a Sharpe of 2, 2.5, 3. And you go like, well, that's amazing. I'd like to have a Sharpe ratio of 2. I'd like to have a Sharpe ratio of 3, was my thinking back then, right? Now, we can speak about the frailties of the Sharpe ratio, but it's kind of like the lingua franca of the hedge fund world. Everybody boasts their Sharpe ratio and goes like 2 is better than 1 and 3 is better than 2. So you kind of like force yourself to look into these strategies that have these high Sharpe ratios. And it's kind of like, it's like a drug. It's like, like a fly is attracted by light. You go there and you want to figure that out. You want to figure out how that short-term trading stuff works, how shorting options, mean reversion, all these type of things. And I mean, now I no longer do this. I know there are strategies out there that have these high Sharpe ratios. And, I think if somebody has a Sharpe ratio of 3, they shouldn't be raising capital. They should just be trading their own money and be very quiet about their strategy so that it doesn't become diluted. So sometimes I'm puzzled by, funds having these high Sharpes and, actually shopping them around.
Yeah.
What I came to realize is that a Sharpe ratio of, say, between 0.5 and 1 is absolutely fantastic. If you can trade at 20% vol, and you have a system that is protective and robust in the way that trend following is, because it keeps losses small and it lets winners run by definition. And if you say you had a Sharpe ratio of 1, then a 20 vol translates into a 20% IRR over time. This is amazing. If you can make 20% on a yearly basis and compound that over time, you'll become very rich. That's a mathematical fact if you keep the money in there, right?
Yes.
Even at 0.5 Sharpe, which is 10% return for 20% vol, this is great. So I moved towards that camp and, accepted the fact that I will trade higher volatility, which today I can handle that. And I don't want to have any of these other strategies in there that have potentially high Sharpe ratios, but blow up risk, left tail exposure, all sorts of things that I don't like, all sorts of things that wouldn't let me sleep well at night because there's kind of like this outlier risk there. Something gaps over the weekend and I may be out of a lot of money. I don't want that. So 0.5 to 1 Sharpe is great. And you can improve your Sharpe ratio or your risk adjusted return or whatever the characteristics of your trading system by combining different styles, have more markets, diversify even more. And what I've put research into spread trading, which took me quite a long time to get done and really, configure that in a way and figure it out in a way that kind of like matched me and what I wanted. And that has improved my system tremendously. So there's always things that you can do, but still in the trend following space, always based on trend, never in the other camp where it's kind of like, a convergent type of strategy where you're looking for things to pull back to a mean and these type of things. I don't do that. So if I can trade at 0.8, 0.9 Sharpe based on trend, that's great.
Yeah, absolutely. And I think so many people hunt for that so much and they don't understand, like there's so many managers even, and you would think at this point, if you do research and you go back a little bit, you'd think that you'd go, okay, this is not viable. I can't do something that nets me a perfect 2% every single month. I had one person tell me they're looking for the system that does 5% every month, and they're selling options and all these things, and really it's like you said, there's a time frame. Like for me, in my system, a 10% drawdown, 20% even doesn't scare me. But what does scare me is, like you said, waking up overnight and being in selling some option on something and something weird happening and boom, I owe everything. My whole system is blown up. That would scare the crap out of me, and that's very possible. Things gap. Things move, and overnight markets. The oil market. We just watched COVID. I can't believe everybody. Nobody even remembers that. It's like it's too far back for some people, but COVID was a crazy one where all of these things kind of did happen very quickly. And you remember 2018. 2018 is a very easy one. You had the optionsellers.com guy, and he was in there.
Was that in 2018?
Yes.
Yeah. Well, time flies.
Yeah, it just at the end of 2018, it was September and October, and oil started going like this. And he's selling puts on oil, and he's selling calls on natural gas, and natural gas explodes, oil goes down, and he loses everything. And it's like that to me is like that's what scares me. That doesn't, the rest of it's like, I know a 10% drawdown can make it back. I know a 20% drawdown you can make it back, but I know if I go to zero, if I have an 80% drawdown, that's going to be very tough to come out of that. And that's why they ended up giving all the money back.
You're right. I mean, look, a 10% drawdown if you're trading at 20 vol is normal business. A 20% drawdown would be normal business as well. Now, obviously, there's a point where you don't feel as comfortable anymore. Say you're in a 50% drawdown, then that is a 2.5 kind of like vol drawdown at 20 vol. And you might say, well, that is within the expectation of the system. That's always what you say as a statistician, kind of like to make you feel good. It's within the expectation, and therefore I shouldn't worry. The problem is something creeps into your head probably at that point, and there is going to be worry, because you're not going to be very happy when your portfolio is down 50%, and it may change your behavior, your psychology. It affects your emotions. What you've said previously, like you don't want to watch, or you don't want to have a look at your P&L every day. Definitely not your dollar P&L, maybe your percentage P&L. I mean, I kind of look at it. Sometimes I skip a day and I don't, but generally, yeah, I'm keeping track of the system, but not like, I don't have to have an eye here looking at real-time P&L while I speak to you. Yeah. I might have a look at how the market's closed later on today, kind of like close the day down and see, what has happened. Have there any stops been triggered, and things like that.
Yeah.
But if you're in a 50% drawdown, you may, even though you're saying today that you don't do that, but you may actually be glued to your screens.
Oh yeah, yeah.
See what I mean? And this is a tricky point then, because this is nothing that you can backtest, and this is nothing that you have any large experience set in. You probably haven't been in a 50% drawdown 1,000 times in your life, so that you have a sample size on your reaction function, right? And the dynamics that play out. Maybe you've never been in a 50% drawdown. So this is going to be your first, and it's going to be very interesting to see what you're going to do. Will you stick to your system? Will you see it through? And how will you behave and react when it goes to 60% drawdown? And kind of like all of a sudden there's a blow up risk there, right? I mean, if you're at 60% drawdown and something weird in the market happens, it could actually snap if you keep the same exposure up, right? Maybe you get margin calls already at that point in time. If you traded at 20 volume, margin to equity is relatively high, maybe 60 drawdown is already game over. So there's stuff then happening. I think that you cannot backtest, and which you'll find impossible to have a game plan for today. You can kind of like think about it and say, yeah, I'm going to be following through. I'm going to be sticking to my system at minus 50%. And I think that's good to say that, and I hope you can, but I don't think there is any guarantee. I think this is in a way uncharted territory for systematic traders as well. Look, our systems are built by us, right? It's a discretionary input function, the way the systems are built and the way we change the systems over time. And at 50% drawdown, I think there's a human element and another dimension to systems trading that isn't there today, when like I make 7.94% in January and 5.7% now in February. I mean, obviously this feels super good. And I don't think about the 50% drawdown, but I'm very well aware that if that, happened, it's going to be interesting.
Yeah. I mean, so
I think I'll probably be a bit better prepared for something like that than a non-trend following trader, or somebody that is kind of like doing this only since like 6 months and has an over optimized system, and they will probably, or they have a higher chance of failing at that point in time. I just hope that I'll be more stable than others, but I also do hope that I don't get to that point.
It's not nice. Great points, and it's I think that's something that so many people really like to overlook, that anything can happen, even though we do have this system and we are talking about, these systems that have this major blow up risk. Everybody can, everybody can have something. Would our blow ups be in a day? No. Drawdowns to that degree would take a very long period of time for most likely, who knows exactly, but most likely it would take a little bit longer than everything else. And continuing to follow a system into that path, will you continue to follow it down 50%, down 60%? How many people, and this is also what creates those panic bottoms in the markets in general is, somebody with Bitcoin that says, I'm going to hold on to it forever. Especially, I've been in Bitcoin for many years and I watched all the panics. And so basically, 2016 to 2017, we had this major run, as you know, and we come down. And, once we get to 6,000, everybody's kind of like, whatever, and I'm fine, that I can handle all this, even though you're down a ton, I can handle it. It's fine. Hodl gang, okay, great. Then it goes down again. It goes down to 3,000. And that's when everybody got out. I need this. I can't live without this. I at least need this much out of this. And they're all selling it at the bottom. And this is kind of what probably happens in a lot of systems too, is that you can only handle so much as a human. We're all human, and so we're it's very easy to come to that conclusion that, okay, well, this hurts. I'm done being hurt. I don't want to be hurt anymore. This doesn't feel good. So my system doesn't work. And then you lose faith in your system. You lose faith in your trading plan. And then you start to lose faith in yourself. And that's really, it's a tough thing. And I think anybody who's held on to any product too long understands that feeling.
It's a vicious cycle. And look, I mean, there's one thing I do about this. I mean, I kind of like, I try to be even keeled, and like when I have these like great trading environments, like, right now, then I kind of like beam myself into a distant past where I've had a drawdown and where I didn't feel as well, and kind of like remind me of, this type of period. And then also reflect on, well, look, I came out of that thing. And sometimes really quickly. Sometimes I've recovered from relatively large drawdowns in a matter of weeks, because trends were picking up and boom, the sun is shining again. So, but there's another thing that I do today, and I have a background in options trading and derivatives and these type of things. So you can kind of like imagine a way where you're eating into a drawdown just because trades don't work. You enter a position, it goes into your initial stop, you repeat. It happens again, it happens again, it happens again. So it kind of like grinds lower and you're taking a full hour loss on those trades. And there's kind of like a string of these losing trades, one after the other, that eats into your position or into your equity. There's also a chance of having a drawdown because something wild happens in the world. And, people tend to say that there's like, crisis alpha. I don't like that term, because there's no guarantee that if and when anything nasty happens, like a gap event, right? Or like yields jumping higher, or, the Nasdaq being down 15% over the weekend. I mean, all these things can happen, but there's no guarantee that you'll have the right position on, first of all, that you actually have exposure to that market. And there's also no guarantee that your direction is right. You might be long the Nasdaq when it's going down minus 15%, which is something that you won't like. So for these type of things, and I'm very confident in my trading system with the spreads and the directional positions, it's a great thing. But I'm also willing to pay for volatility and protection still today. So I do have options positions on long volatility, long vega in essentially different asset classes. I'm long calls on oil, for instance, far dated, 23, 24 deck, 100 strike and higher, right? So it's kind of like I get that convexity on energies moving higher. I'm long volatility. If something crazy happens there, and volatility spikes up, I get it there. I like buying cheap fixed income volatility. I sometimes, buy volatility in the equities at, when the VIX is at 15 and stuff like that. And, I do that. It's not 15 for like far dated options, but, you can get stuff out there, and it's kind of like, it has that protective element, so that when things go crazy, there's a cushion there. I will profit from my options positions. And then they give me optionality hence the name, to either monetize them, roll them into other strikes. But that is something that I do, and I think it helps my trading tremendously. I actually get a lot of return as well from that. So I'm not just paying for protection and paying the premium away, kind of like an insurance policy. I'm actually getting protection, and for the most part, I'm able to make money out of that.
I mean, and not to mention, making some money on it. Call options and oil over 100, definitely. That's a
yeah. I mean, look, it's massively backwardated, and I started putting those positions on probably in September or so of last year. And it started with like 80 and 90 strike calls back then, deck 22, deck 23. And, the delta of these calls has become higher and higher as spot has moved higher. The curve became even more backwardated. Some of that far dated stuff stayed really low down there. It's still sub 70 in, deck 24, I think, when I last looked. And, you can trade a call option, deck 24 for say $5 with a strike of 100. That is a great addition I think, to my trend following trading system, which is long crude oil anyway. So I get, it's in the right direction of the trend. I'm long. I have paid for the optionality, but I am long gamma and long vega. So if something goes completely wild, then there's another dimension there that I get, another nonlinear dimension that helps my trading system. If oil dropped 10% over the weekend, or 15, and sometimes it does do that, then I'll look much better with my call options than with the directional position, because the convexity works positive in both ways. And so, but I still have a directional futures position. But what I do is I optionalize some of the P&L that I get. I got long oil, I don't know, around 50s or whatever, I don't remember. But there's positive profit, there's positive equity, there's open profits, and I can take them. I'm not taking them off the table. I'm a trend follower. I want to stay exposed. I just change their nature from delta 1 to nonlinear space in options. That's what I do. But I only do that when the market is good for this. And in crude oil, it's amazingly good for it right now. Volatility isn't very high. The thing is completely backwardated, very, very steeply, which means the far dated options are relatively cheap, and the far dated options have a lot of vega. They will have a lot of reaction to a change in implied volatilities. So I definitely like to do that. If it were in contango, I probably wouldn't do that. I'm not sure if I'd be long then. Right. And you can look at the fixed income complex in the same way. There are some, incredibly cheap volatility. FX too.
Yes.
Maybe equities not now, but this is kind of like the thing that I add to my system that is discretionary. Spreads trading, fully systematic. Directional futures trading, fully systematic. Doesn't need me, just needs me to kind of like operate the system and make sure the system is being followed. But then depending on market environment, depending on volatility, depending on the availability also of options. I mean, it's not like, you can trade options on all of the markets, and you certainly can't trade them far out on all of the markets. But depending on the position I have in the portfolio, I would optionalize some of the P&L that I have as a trend follower, with a view of getting an even fatter outlier, an even crazier outlier move with more convexity. That's what I want.
And that's something too that you kind of pay it's almost like paying another person to kind of take over that risk there. Here's this trade, I'm going to put this on, but then I'm going to also just kind of leverage it a little bit. putting this type of trade on. I really like that idea. And I do that in a couple markets. And like you said, it always has to be when it looks right to do it. When's the right time? And you gave some great examples of how you look at that and how you figure out what's right and how you kind of figure out which direction you're going to go. And also the long volatility in general is so important, in a world.
It doesn't always work. I mean, look, I've had it many times that, I'm buying optionality, long put, long calls, whatever, and it doesn't work. Volatility grinds lower, the market doesn't move, right? Now, then in those instances, I may have paid a little too much for the option premium, and I wouldn't have lost the equivalent of the option premium in Delta One space. And this is kind of like, okay, I've paid some money for insurance if you want, and I get out of the position. But yeah, what else? I mean, I look for trades that have, in general, I mean, that is, it probably goes without saying, but you want to have a multiple risk reward, right? You want to have multiple upside potential vis-a-vis the risk that you have today. Sometimes like an option, and sometimes you can see that even in Delta One space. So one, and you may have followed me on Twitter on that. I mean, one trade was TTF Dutch Gas earlier this year in January. That thing, the winter spread, the Widowmaker, sorry, the Widowmaker, not the winter spread, but the March-April spread became incredibly cheap in light of Europe running out of gas, storage being incredibly low, the conflict in the Ukraine, yada, yada, yada. So everything was like, if the fireworks go off, that thing's going to explode, and it did. And you had very limited downside. So, you kind of like have to put these trades on.
Yeah, no, I agree. And, that's where I also use a lot of things in a similar sense, because I think it's very important to have those type of trades. It diversifies you from this, we're trend followers, we're putting all these on, but you kind of need these other trades. And especially like if you're in a market like we've kind of been in, where so many things we're long, now we're kind of getting to some things are short, some things are long, but so many things were long for so long. And just to have some other types of trades, I really like the spread idea you have. That's very cool. And so many trades just, you get, so we're basically short volatility in a sense, in a lot of markets. And so having something that is ready for that volatility to come in, like you said, the VIX is at 15, like, especially these years, at this time, it's not going to stay there very long. Most likely. I'd be very surprised, at least, if it does. And yeah, you never know, but you see this explosion in that. I mean, it kind of reminds me of the market in the 90s, where you have these kind of this major volatility is a little bit higher. Volatility is always, you have these moves that are a little bit bigger than normal always. And anytime the VIX gets to a certain point, it's really jumping. It's not like 2017 where, you have volatility go so high and just draw down. And the markets that was probably the most boring market of my life was 2017. There was nothing, not even that I need an exciting market. It's just, there was nothing going on. Yes, if you're an equities trader, yes, the market kind of went up, but everything else was just stagnant. And so we're kind of seeing that we're in a kind of an opposing environment. There's events happening all the time. It's a good time to kind of be an options trader.
Yeah, look, I like it. It helps me.
So on that subject too is 2020. And I wanted to ask you about this too.
On a second, Jason, I'm sorry, I need to open the door.
Yeah,
real
go ahead.
Quick. Maybe we can make that 30 seconds. I'm back in a minute, if that's okay.
Yeah. So yeah, what I was getting at is 2020. So for myself, I continued to execute through this, and I did very well during that time. But I knew a lot of funds and traders, especially systematic traders, just kind of stopped trading. It got too crazy. The volatility was too high, and they stopped. For me, I took position sizes. They got a lot smaller. I didn't feel comfortable using the same size, which isn't very normal for me. I usually do, but I got a little bit smaller. I did a couple things because when volatility was so high, I sometimes will do that. It's very rare. But I wondered, what do you think about that? Do you think that people should have that was a right way to handle that, or do you think people should have continued to execute their trading plan, or do you think it just doesn't matter and everybody's just kind of different?
I think people should execute their trading plan. In a way, COVID to me is almost like that period, February, March, April, kind of like, that type of time frame when we had the V-shaped recovery in the S&P 500. And I mean, of course, this was a crazy market. I mean, we've never seen anything like it. None of us have ever lived through a pandemic or experienced one, at least not of that magnitude, right? And the reaction of the markets was intense. But it kind of like became this excuse. Nobody could have seen the V-shaped recovery, and of course that's true. Nobody could have forecast a V-shaped recovery and oil going negative in April or May of that year, and these type of things. But this is essentially one event, sample size one. And if you're using that instance to change your system, then I'm not sure why your system's straight to begin with.
Yes.
Your system should be able to ideally handle that environment. That, when I say handle that environment, that doesn't mean that your system should finish that environment with a profit. It may lose money during that period of time, but it should not completely fail. And my system did not fail because it was diversified. I lost money on the equities. I mean, having the V is for a trend following, type of trading. I mean, unless you're like super short term in your trading approach, but I'm not that short term. So for me, having these V type of patterns in the market is obviously not nice. But there were other markets. I mean, interest rates, from what I remember, I made money on the interest rates. I became short crude oil relatively quickly. And that was a home run trade. Gas oil, heating oil, gasoline. I mean, all of these markets, they've made me a lot of money. The commodities, some of the currencies. So I'm looking at the number here, 2020, I lost 2% in February. I made 2.5 in March, and then I lost 45 basis points in April. So that means I didn't make a lot of money during that period. I had losses from the equities. I definitely remember that, but it also wasn't a disaster.
Yeah.
In 2020, I ended up with a profit. So that doesn't tell me that I should be changing my system. It can only play with your mind and kind of like trick you, like when you live through the moment and you kind of like look at every day and how crazy the markets are, you feel uncomfortable, and in that moment you want to change your system because you can see, hey, trading shorter term is now the right thing to do. But now, this is now 2 years back, right? And I look at kind of like monthly P&Ls here in front of me. Looking at that period, there's nothing, absolutely nothing abnormal about it.
Yeah.
This is just a normal, even less magnitude than usual, than average, trend following monthly performance for my system. Like if you didn't tell me that there was COVID, just by looking at the numbers, there was no COVID market behavior, if you see what I mean, right? And some hedge funds came out and some traders came out and they said they changed their system. They have changed their system in response to what happened in February and March of 2020. And on the podcast with Niels and Jerry, I think I said it very clearly. I don't think there's a reason to change anything unless you had a bad system to begin with. But if you have a good system, then no, not because of this one event.
No, that's a good point. And I just think that so many people got so spooked, and it was mainly based on like your life experience, right? because nothing really crazy happened that was abnormal in the market. Yes, it was abnormal to have so many limit down days and all these things, and panic is hard, but that's happened. We will always have panics. We will always have these things happening. And so I think it's great what
Yeah.
you, because it's just, for me, it was a learning experience. Running a system through something like that is something I've seen some nasty periods, but I've never really ran a system through something like that. And I think it was a really great learning experience of, like you said, looking back and going, well, that wasn't that bad. Like there wasn't anything really that abnormal.
Yeah.
And not to mention, if you were a trend follower, most of our systems were shorting energy before the pandemic. The pandemic happened, and you kind of had a very long breakdown pattern that happened right before the pandemic. Oil, I think, it was hit right under 52. I think was where my system kicked in. I can't remember the exact number. Whenever that base got broken, and then we had that breakdown pattern, and we shorted it. We're the types to be in those shorts when it doesn't make any sense. Oil can't go under $40. Remember, that was the oil can't go under $40, and then it goes under to 30. Oil can't go under 30, and then it goes to 20.
Yeah.
And the same with the bonds, like yields can't go under zero, and how many people were, it was just us basically being, no, we could still be long bonds right now. The system saying to stay long bonds, I'm staying long bonds. Yes, it might not make any sense logically, but nothing does. I don't look at the market and see anything that makes sense. I don't read the news and go, well, this makes so much sense to me, I better
That's
buy
right.
this. And so I have no problem staying short or long something that doesn't make sense. So I think that was well said.
Look, there's always something going on, Jason. I mean, over time, the longer you trade, the more of these periods you'll experience. And, the COVID period, COVID is still here, it's still ongoing. The market is reacting very different today than 2 years ago, obviously. But it's kind of like in this period, you can step back a little the more you've experienced. I mean, the next year, you've had GameStop and AMC. We had craziness in the lumber markets. I mean, it's countless. You had the Swiss franc type of thing in 2015. We had a European debt crisis in 11, 12, 13, kind of like that time frame. There's always something crazy happening, and something is affecting your system. But that shouldn't make you drop your system unless you can detect that there's really something wrong with it. Otherwise, you just let it run because you've seen the trade statistics in your backtest. It's a large body of evidence. It does have edge, so you should be following through. In your backtest, there were periods that were crazy. LTCM, the Russian ruble crisis, the Asian debt crisis, Argentina defaulting,
Yes,
the global financial crisis. I mean, you name it, the tech bubble bursting. It's all in there. You've tested it, and you didn't change your system because you don't have a dynamic backtest with changing systems. So just follow through with it, I think, is the best way to do. I guess some of the hedge funds that are in the business for making 2 and 20, nobody makes 2 and 20, but they're in the business for making a fee. They need a story to tell. So they get called by their clients, and their clients say, well, this is absolutely nuts what's going on in the markets, and oil trading negative, and what do you do about it? And they feel pressured to give them an answer. Yeah, we're here, we're stewards of your money, we take good care of it, and therefore we've made an adjustment, we've turned the dial, and we're now, I don't know, less risk seeking in the energies because it has traded negative, and that shouldn't have happened, so we want to stay away from that, and so we're reacting to the market, and therefore you should pay us. Well, not really. But maybe they feel forced to say something like that. But since I only trade my own money, I don't have to answer to anyone on any of these calls.
And that's a plus, and that it's just so many of these things, it's just I think so many people really struggle with that fact of just sticking to your system, sticking to your plan. I think that's the real hard part of trading in general, because at the end of the day, you can't listen to
a guru. You can't listen to me and do, exactly what you make exactly what I do, or do exactly what you do and make exactly what you do. Nobody can do that, but really coming up with a plan, sticking to it during all the things you mentioned. We went through all these different things, and we have, and if you go back all the way to the beginning of time, we've gone through a lot more. And we will continue to do that. And the market will always be crazy. It will always be seen as, this thing that's different and kind of unique. And there will be people panicking. There will be people freaking out. And there will be all these things happening. And what you can do is follow your plan, follow your system, continue to do these things, do the next right thing, basically.
Yeah.
Continue to do
And have an open eye on the risk. I mean, no system, I don't want to be sounding as if, the system that I have today is set in stone for all times. It very likely is not. And, adding a market or removing a market from the system, that is one element of changing it. That's not really changing the underlying dynamics of like, how do I get in and out of a position? But even that isn't set in stone forever, or my position sizing. I mean, one example is, for instance, the short-term interest rates. And you've mentioned it very correctly. I mean, many people were saying that, 0 is the absolute lower bound for interest rates. And then that proved not to be true. And, European rates went negative. So if you had closed your long bond positions because you thought that 0 is the floor, then you've missed out on a great ride from, say, in the boon, from 0 to -70 or wherever the thing was back in the days, and that was great P&L. But what you'd also seen is the compression of average true range, and the compression, obviously, of volatility behavior of the short-term interest rate markets, like 3 months all the way out, like euro dollars and short sterling, and bank bills and these type of markets, Euribor, LIBOR, and kind of like you got a signal, and if you don't make any change, if you keep your system unchanged and the way you designed it, say in 2000, then you end up with a huge position size, massively over very large ATR normalized position size in short-term interest rates. And normally this is what we like, right? We like to give every trade the same chance of contributing to the portfolio. So we want to size them all by ATR. And there's a risk now with the short-term interest rates. That is too large for my liking. So, I kind of like had a minimum ATR, or a volatility floor, if you will, on these type of markets, so that I don't trade as many contracts in those markets, because I don't want that tail event to sting me. If there were a large move for whatever reason in any of these short-term interest rate markets, they could really hurt me, and I don't want to be hurt. I just want to have good risk control trading, protective portfolio setups. That's what I do. So what that means is, even though I've designed the system in such a way that every market is treated in the same way and every market has the same chance of contributing P&L to the portfolio, that type of change means that I'm kind of like now treating the short-term interest rates differently, because I give them less of a chance of contributing to the P&L of the portfolio. In terms of frequency, how frequently they trade, they get long, short, entry, exits, still the same, but their position size is smaller. And I may change that again in, I don't know, the future, 2, 3, or 4 years down the road, when interest rates are again higher and there's going to be more of a volatility dynamic in the short-term interest rate space. But right now, that's not the case. So I don't want to overtrade there.
Very good. So I think, so we're wrapping up on time. I don't want to take too much of your time, but do you have time for one more question?
Yeah, sure.
So this has been great. I really appreciate it, because this does also like helps me a lot just to learn constantly. I'm always learning from you guys constantly.
Yeah, same here.
And so I was thinking, what we like to end things off on, just you meet somebody you meet yourself. You're about 2 years into your trend following journey. Like, you find these moving averages. You're like, this is kind of cool.
what would you tell yourself at that point, somebody like that? Because we have a lot of guys that follow this that are at that point in their trading.
Yeah, that's a great question. I should have traded at higher vol sooner, because that would have compounded more nicely. Should have, could have, would have, right? But it took me a while to really be fully at ease with the way that I trade today. No vol controlling, relatively high volatility, profit givebacks is kind of like the daily bread and butter business. Being exposed to outliers, waiting for these outliers, having these response functions where a lot of things don't work trade wise, and then there's this boom, one or two trades that really become home runs. That is now something that I'm completely fine with. I completely get it. That is what I want. I want to live exactly that way, even though it's counterintuitive and most people wouldn't like that. But getting to that type of understanding sooner would have helped me a lot. Because when you start out as a trend following trader with these type of systems, you understand the theoretical backbone of it. How do you get long? How do you get short? How do you get in and how do you get out? And how do you position size? And all these things, yeah, you can understand them. You read about them, you test them, you try them out. But you cannot test your human behavior when these systems are actually live. Yeah. That is not in the textbook. The textbook doesn't teach you how you will feel with high volatility. And it doesn't teach you how you will feel when there's 10 losing trades in a row or 15 and stuff just doesn't work. So that is something really that everybody has to learn for themselves. And I'm on the record saying there is no demo account, there is no paper portfolio that will ever do this for you. There's only one way of doing it, and that is with real money, and it must be your own money. You have to feel the pain, and you have to feel the positive emotions as well when things go really well. Yes. That doesn't mean that you must overtrade. Don't overtrade. I mean, you can do that with, luckily, relatively smaller amounts of money than back in the days with, on interactive brokers, if that is your broker. I mean, I'm not necessarily using that one, but, there's micro futures. You can trade some of the ETFs. There's a margin account, you can fund that. So you can trade a bunch of different markets. You can be a trend follower with a relatively diversified portfolio, say 20, 25, 30 or so markets. Don't overtrade them, but get going and get that experience under your belt and see if you really like it. See if that really is for you. And I wouldn't be surprised if, say, 3/4 of the people trying it out would actually throw in the towel. Maybe even more. Maybe 90% will say, you know what, that's not for me. I'd rather like the 3 Sharpe ratio, mean reversion, short volatility type of thing. And then I'll stop. And what's kind of like what's so interesting is we're doing these conversations like I'm talking to you, or we're doing these podcasts, and there's like all these Clubhouse and many podcasts out there educating an audience that's interested in trading, and kind of like saying you should be doing more of the trend following, and trend following is great, and that strategy is great, and it has all these benefits. And you kind of go like, yeah, that's true. I mean, if people actually adopt the style, they invest in a trend following fund, or they build their own trend following system, then if they do it the right way, that's going to be beneficial for their portfolio. And so you feel good about that. I mean, tell them to do that. At the same time, you go like, well, I don't really want everybody to do that. It's pretty much okay with me for 90% of the people that, embark on the trend following trading journey to fail and give up on it, because obviously the more people do it, the more they compete with me. So it's kind of like that double-edged sword. Like, we're speaking about it, we're giving away, I'm not giving away my secrets, but like Jerry and Niels and Rich and myself and all the people that you were speaking to, even though we don't give away the details, we give away a lot in the way that, like, this is how you should think about it, this is how you can set up the system, this is how you should trade and view the risk and these type of things. So we're giving you kind of like a manual, but it's like with a cookbook, right? If we read the same cookbook on spaghetti carbonara, even though the rules are exactly there, you read the same rules as I do, your spaghetti will taste different than mine. We'll have a slightly different approach to how we cook them. And for most people, that spaghetti will taste awful. And they'll throw it in the trash can, throw it in the bin. And being a free market capitalist, that is also a good thing. You know, we don't want everybody to be successful, because if that were the case, then there wouldn't be as much profit potential for me.
No.
So I want to be honest about that as well.
No, good points. And I think that's something that's very important, is that, and not to mention, it's like I said, and in the middle of this, which was, I think that, you know, you could put up, you know, a big banner of, hey, this is exactly what I do, and you could do this too. And I think that, you know, out of 100, I think you'd have 2 people maybe continuing doing it in 6 months, and probably 0 continuing to do it in a year. And that's kind of, I think that, and that's another thing I think a lot of people think is, they read a Market Wizard's book and they go, okay, well, Market Wizard's book was good, but these guys didn't tell me the secrets. And it's like, no, we're really kind of telling you everything you need to know. Because if I even tell you the amount of days of, let's say, a Donchian breakout system that I use, if I tell you the days, I tell you everything, you're not gonna stick to it. You know, you're not gonna use it. You're not gonna continue to do it. You have to build those things for yourself, and you have to really have that inside you. So I don't think it ever gets to that point where it's, hey, there's so many people using trend following systems that it doesn't work anymore, because I think forever we will be kind of vilified in the way of, well, those guys, you know, they're crazy. I mean, there was I forget his Mark Minervini. Mark Minervini he went on the TV the other day, and he said something, and he couldn't hear the guy, and he's been vilified for, you know, a couple months now, or maybe a year. I don't even remember when this happened, but he said I didn't understand. And then everybody's like, he doesn't know what he's investing in. It's like, I don't know what I'm investing in most of the time. I am a price actions trader, you know, like I trade based on price. I trade based on my systems. I trade based on these things. It has nothing to do with that. And so I think as long as most people have that in their head, there'll never be a exodus to trend following. Everybody will not run to and go, this is the way we're going to use these systems, and this is great, and you guys figured it out, you guys are doing great. So I would be very, very surprised if that ever happens, even if we gave everybody everything, because people aren't comfortable investing in things that they don't know exactly what it is. Yeah. I mean, I added canola oil to my system probably, it was recently, it was only 2 years ago, I think. And last year I had obviously canola's done very well. I had a couple of really good trades, and I'm sitting with my girl, and I'm talking about something, and somebody says canola oil, and I say, well, what is canola oil? And my girl looks at me and she goes, you have that position on your board, like, you know, what are you talking about? And I was like, I have no idea what it is. You know, what is it? What is it used for? And that's really the truth. You know, yeah, I can look at supply demand numbers. I can look at the curve. I can look at these things and understand that. But past that, I really don't. And I think a lot of people just aren't comfortable with that at all.
Yeah, palm oil. I mean, whatever. I mean, there are so many markets that I trade at. I don't even know what price level they trade unless I look at the chart.
Yeah.
They're just, you know, it's a ticker, it's an uncorrelated market in my system, it's liquid, and hence therefore I'd like to have a look and potentially trade it.
Yes.
All I need is open, high, low, close, and that's it, essentially. Like, you know, over I want to have a sample size and a history in the market, but other than that, just give it a go.
Yeah. That sounds good. Well, it's been great talking to you, and you really nailed some stuff today that I really had some questions about, and it was cool to really talk to you and get to meet you. And thank you so much for coming on.
Thank you, Jason. Much appreciated.